Hello everyone, welcome back. I got some really good ones for you this evening, but first, I hope you've had an awesome week. Happy Friday, and I hope you have an awesome weekend as well. Let's dive right into it, shall we? Markets. The three major US stock indices getting beaten up all week. It's these rising interest rates, rising bond yields, and rising relative strength of the dollar. Those three themes are putting so much downward pressure on risk assets. I don't care what you're trading, NASDAQ, oil, Bitcoin, gold, it doesn't matter. It's all getting beaten up by this dollar that in relative terms is just getting way too strong. The dollar in absolute terms, weak. Shelf it. We don't even need to talk about the inflation we're seeing at the grocery store, at the pump, how that's not gotten materially better, and in the eyes of most market participants probably won't get a whole lot better. So shelving the absolute strength of the dollar being very weak, meaning you're trading your time for money and a job in the United States, and then you're going out and trying to transact. The dollar's looking really weak. It's hurting. I don't see that changing. However, the dollar's relative strength, so when compared to all these other government issued fiat currencies, the relative strength of the dollar is doing really well, and it's hurting all these other emerging economies, or just anyone who's not the world reserve currency. They're getting killed. They have their own inflation problems, a lot worse than the US. They don't have the privilege of being able to be the world reserve currency status and kind of export a lot of this inflation. So dollar's getting beaten up, but everybody else is getting beaten up worse. We have rising bond yields. So as this bond bubble, tries to deflate, those bond yields go up. And then when everyone sees the bond bubble deflating, that spooks the stock markets and risk assets, other markets. And it kind of has a domino effect. So until credit market instability gets addressed, those other markets get beaten up pretty good. And we saw that my last video where I talked about the leveraged UK pensions. The UK debt market starts to become very unstable. Those yields in the British gilt keep rising, and it's only a matter of time before the Bank of England feels like they have to step in. They have to buy bonds or gilts. They have to drive those bond yields back down, prop bond prices back up to kind of strengthen those balance sheets for banks. And then that allows risk assets to go up. So the Bank of England did blink, and they're trying to kind of ease and be accommodative, even though they're putting like 3-day limits on it. It's so funny. Look up how the Bank of England's trying to do like quantitative easing till today, till Friday, and then take the punch bowl back away. That's so funny, because even if you're a proponent of these central banks and believe in bringing price stability to markets, well, what's stable about a central bank being like, punch bowl, no punch bowl, we'll help you a little bit? But it's so funny, because they have to create solutions for the problems they created. You know what I mean? They have to make a big mess and then offer you a solution, but only till Friday. And then, because we want to ease, but we don't want to destroy our currency even more, so we're just going to ease till Friday, and then we're going to take it away. And God, that's ridiculous. Every central bank is guilty of this, though. They're it's something else. So the Bank of England is, trying to be accommodative and kind of keep their credit market stable, which allows their other markets to remain stable. I mean, everybody's just kind of playing whack-a-mole with their own little problems that they created, over the last few years. So we're seeing that. We're seeing instability in other countries' currencies, other countries' debt markets. And we're seeing a little instability in our own. Look, when that 10-year yield hit over 4% this week, that really freaked out the stock market, gold, Bitcoin, oil, whatever. It freaks out everything that's not a dollar when those yields are just moving up that quickly, that steeply in such a short amount of time. So these yo-yoing credit markets globally are what are sending shockwaves out to all these other risk assets. So if you're hyper focused on your market and your risk asset and whatever you're trading, you're kind of missing it, because it's the rising bond yields, the rising interest rates, and the rising relative strength of the dollar that's smashing your favorite risk asset. We're continuing to see that. The Bank of England blinked, but the Fed, has not, which is kind of crazy. I figured by now the Fed would be flipping more dovish, taking some of these interest rate hikes off the table, kind of dangling that carrot. Maybe well, we'll get to that in a minute. My point is the Fed is trying to play poker, like keep a good poker face and be like, we said we're going to tighten, we're going to raise interest rates this much, we're going to do it. What you got? And the markets are, kind of been in denial about that all year, and now are ultimately getting to a point like, dang, the Fed is really not messing around. They keep raising interest rates, and it really just, keeps messing up these markets. So we're kind of at that point. I do think, though, the Fed will flip at least a little more dovish in their rhetoric over the next few months. Look, they have to, because things are starting to break. You're seeing it. Real estate markets are breaking. All sorts of markets are starting to break from these rising interest rates, rising bond yields, and a rising dollar. So you're really just, the $64,000 question is, when does the Fed flip? When does the Fed start talking about interest rate cuts, start talking about expanding its balance sheet, and as soon as that happens and the market starts getting a whiff of that, the Fed is putting the punch bowl back. The entire global economy, including like U.S. equities, should begin to rally. It's just a question of when. So you're waiting on a Fed flip. Some people are going to wait till after the Fed flips, Dove, in order to buy risk assets and kind of chase everything higher. I'm going to leave that to you. I don't really think my personal opinion, nobody's going to be able to guess the bottom of the market they're going to be able to get it maybe down to a 90-day window when they think the Fed will flip, but where the actual bottom is anyone's guess. Because the real premiums are buried in those really deep, dark holes for risk assets where the market really doesn't think the Fed's ever going to flip. And that's where you get those really cheap prices, because then as soon as the market does think the Fed's about to flip, it's already rallying, the market being very forward-looking. The stock market today is ultimately trying to figure out where it's going to be in 18 months from now. Like, that's how forward-looking the stock market is. So if you wait for the Fed to flip, meaning the Fed stops with all this hawkish rhetoric, stops talking about QT, stops raising interest rates so aggressively, as soon as that happens, the markets are going to be one step ahead of you. They're very forward-looking. So where the bottom is just where the point where, in my opinion, there's just so much pain and nobody thinks the Fed's ever going to come back, and they're just so certain of that. That's where you get those capitulations, right? Where the price of, any given security just cannot find a buyer and catch a bid. And that's where the premium is buried, because by the time the Fed's flipped, that asset's already gone up by 20 or 30% off of its all-time lows. So it's a big guessing game. When do you think the Fed's going to flip, and how quickly do you think markets are ultimately going to react to that? But that's the big game you're playing. All right, it's not really so much employment, like how many people have a job. It's not. As a matter of fact, I think the Fed is about to let unemployment begin to rise, meaning the Fed is going to allow jobs to be destroyed. With the unemployment rate only at like 3.5%, 4%, the Fed could let that thing go up 1 or 2% before they really start wanting to flip Dove just to save jobs. So I think with all this fake money in the system and the Fed needing to bring consumption and demand down, I think they're willing to let a few jobs go. That's Bandit. Hi, Bandit. He's helping with the video. Bandit says wait for a Fed flip to buy, but I'm saying think twice about that, because the market is very forward-looking and it's much craftier than you and I are. So these markets are trying to find a bottom in the face of a Fed that is just, arms crossed. Nope, we're not going to cut interest rates. We're not going to take any of these interest rate hikes off the table. We are fighting inflation. And as long as they're doing that, it kind of puts downward pressure on risk assets, all right? Even if it is ultimately a lie that the Fed raising the overnight lending rate between banks, the Fed funds rate, raising that's going to control inflation, even though that's probably a lie, and the Fed would need to do a lot more in order to get inflation under control, well, the market kind of believes it. So if the Fed can just sit back and have its arms crossed and try to act like one of those parents that's like disciplining their child and really holding them accountable and not flipping, that's kind of what you have. Like the Fed really trying to show that its feet are firmly planted and its quest to solve inflation is a top priority, and that freaks out markets. But I'm waiting for that to flip, okay? So you're waiting on a Fed flip. I don't care what you're trading. And until then, you're going to see pressure in risk assets, high short interest in the market, meaning a large percentage of players are betting against the market. You're going to kind of see that. But as soon as those interest rates start to come down, the dollar starts to weaken in relative terms, and bond yields start to come down, well, that's green light for risk assets to start really moving up. So kind of what you got going on there. All these countries' central banks are just kind of playing mind games with people. Bank of England's right now being my absolute favorite with the easing till Friday kind of thing. Like that's basically like the Bank of England took the punch bowl away from the market. Now the market's like not drunk anymore. It's having like this horrible hangover. And then finally the market was just like, I need a drink. And then the Bank of England's like, all right, here you go. I'm going to put your spiked punch bowl out, but just for 3 days. So then the British government and the pension funds kind of go on a little bender, take a few shots, start to get a little wasted again. And then the Bank of England comes in, kind of takes the punch bowl away. But there's no price stability with this, right? We're easing, we're tightening, we're easing, we're tightening. And really kind of messes up price signals and kind of, undermines their own credibility, and they already have a credibility issue. So, point and laugh at the Bank of England, point and laugh at the Federal Reserve as soon as they flip, because it's coming. They have no choice. And we're just going to keep going, all right? Bitcoin, oh my gosh. So Bitcoin and cryptos, they're two different things, are both under immense pressure from, well, this is actually kind of complicated. The NASDAQ is very interest rate sensitive, and that's been under a lot of pressure from these rising interest rates all year. And I would say the crypto world, like all the altcoins, are kind of tied to the NASDAQ in that respect. And then I'd say Bitcoin over here, which more or less competes toe-to-toe with the dollar and kind of acts like a digital gold. It's also getting killed from these rising yields, rising interest rates, because it just competes so much with other currencies and the dollar. So as soon as the dollar weakens, Bitcoin should disproportionately like move to the upside. And then I would say for altcoins, they will also disproportionately love a weaker dollar, lower interest rates, lower bond yields, but kind of more like for speculative NASDAQ centralized unregistered security tech stock reasons, right? So Bitcoin is kind of its own thing, completely decentralized, not really application other than just being the money. And then you have all these cryptos that spun out of Bitcoin that are really just like really speculative tech stocks that are hoping they can, provide some sort of value to the marketplace and kind of bring a new application to the finance world. So Bitcoin and crypto are, fundamentally different things, but they are both hating these rising yields in the bond market, rising interest rates in the dollar, and rising relative strength of the dollar. Hate this stuff. Everybody's saying, though, Bitcoin's going to hit like 12,000, though, and to wait till it does to buy. But because everyone's saying that, I don't think it's going to. So, it's a guessing game. When do you think the Fed will flip? Leave a comment. If at all, maybe they won't. And maybe also if you think the Fed flipping won't do anything for markets too. Whatever your perspective could be, let me know in the comments. I love hearing from you guys. Kind of a quick video today, but I'll be back as things progress. Like, subscribe, share, comment, whatever. You guys are awesome. Thanks for listening. Hope you have a wonderful weekend, and I hope this kind of gives you an idea, at least for where I'm at. Not any buy or sell recommendations. Till next time.